David Morgan is an expert on silver, gold, and precious metals investments. He's a world-renowned lecturer appearing on CNBC and the Fox Business Channel. He's an author, having penned Get the Skinny on silver investing. And Mr. Morgan is a regular contributor and friend of the Ellis Martin Report. David, welcome back to the program.
It's great to be back.
We're looking for sunshine with regard to the mining sector. Where is the sunshine? Where are the deals? What's going on with regard to silver, gold? You are the silver guru. There are many people in our listening audience that are holding on to quite a bit of it. And what do you have to say to them today?
Well, the first thing I would say is, where's the sunshine? It's very obvious from doing an objective analysis that the best place to be is actually in the mining sector. The value or undervaluation in the mining sector is at a level that just begs people to get in there if they understand value and understand so many of these companies are undervalued. That even more so than the bullion itself. But having said that, I really want to repeat that it's more important to own the physical metal than the mining shares. But as far as on a purely objective basis, the mining shares, for the most part, there's some, and it's a very tenuous time and has been for quite some time, to know that we should be looking at, value across the board from speculative to mid-tier to top-tier companies, because top tiers are doing mergers and acquisitions. Mid-tiers, you got to make sure their growth profile's on track. On the speculative side, which is the highest risk to reward ratio, you got to be sure that whoever you're speculating with, who put in money, can afford to lose, and they have the wherewithal to continue going if this bottoming process continues much longer.
You mentioned mergers and acquisitions, and there's a friend of ours, a mutual friend of ours, that has benefited recently from an acquisition where a major mining company picked up a minor mining company in South America. And I guess what you've been doing with regard to your own subscriber base is laying groundwork over the years for these types of takeovers, and that's where the money seems to be benefiting investors right now who've just been patient, who haven't sold out their positions, and these potential takeout candidates have been taken out.
Exactly. Because we do delve into the mining sector so deeply, we did an article in the Morgan Report some time ago that talked about mergers and acquisitions. We talked about the likely candidates that would be picked up, and then we also talked about the companies that were most likely to make the moves on those companies. So we looked at the ones that would be acquired and the ones that would be acquiring. And actually, it's pretty interesting what we wrote and what's come to fruition. We certainly haven't got it perfect, but we were pretty accurate so far. And of course, there's more to remain to be discovered. I think this mergers and acquisition situation is going to continue for a while. We're still undervalued in a lot of areas, and there's a lot of bigger companies that have a lot of cash. So the ability for these larger companies to acquire smaller ones still exists.
How can you accurately target those potential acquisition candidates? How are you doing that?
Well, you look at what the present value of the company is, and this is just one of the first things you learn in finance, and you could certainly learn it by teaching yourself how. And then you see what the net present value is, and then you see what the value of the marketplace is. So for an example, let's say that XYZ mining is worth $100 million, and right now the market has it at $25 million. And that it's got a situation where it's mining at a small level and it's in a good jurisdiction, et cetera, and it's close maybe to a major like an Agnico Eagle. And so then it's pretty easy to say, well, that's an acquisition target. The main thing is knowing how to appropriately determine the actual value of a company. And of course, on the exploration side, you usually cannot do that process. In the Morgan Report, what we do is in the top tier, I tell everybody every month which are the 3 best performing top tier companies. That's pretty easy to determine, but you can't do that in the junior sector because you'd have to be clairvoyant. You'd have to know the future, because an exploration company or even a small junior that's putting out a small amount of product of ore, you don't know exactly how the growth profile is going to be or whatever. One that we have in that category has exceeded our expectations. In fact, it's been one of our best performers, and we keep referencing it in the Morgan Report. But it's something in that sector you can't. I'm just saying that because I had a reader. I love the fact that you give us the best of the best in the top tier just tell us the best of the best in the speculative sector. And it's like pretty tough to do. We did put out a list of the most undervalued in the Morgan Report. And again, some of our readers thought we were talking about who our favorites are. Well, there's a difference between a favorite and an objective analysis of which are the most undervalued. And a company that he held a big position in wasn't mentioned as one of our quote-unquote favorites, the way he read that particular issue. So I addressed his question, the benefit of all readers, stating that, no, this isn't a popularity contest. Yeah, your company that you have, I like the management a great deal, but that's not what we're writing about. What we're writing about is where you can buy $1 for 50 cents. We're talking about undervalued companies. That's what we did. So I think he understood that reply, what we intended. And obviously, we weren't probably as clear as we could have been in the initial analysis of which were the most undervalued. We're always working toward helping our membership as much as we possibly can, but we can't control the market. Quite honestly, I thought that we've been at the bottom a couple times. We haven't been there, and I still think that we have bottomed. Yet I actually did an interview with Avi Gilbert, who is a big Elliott Wave type, very smart guy. Met him at the PDAC, had a chat with him before he got on stage and spoke. I came in and listened. Very articulate, very knowledgeable, very, very bullish on the metals, extremely on the silver side, and more so by far on the HUI, which means the mining sector stock-wise, than he is on the bullion price. So all those things lined up for us in the Morgan Report very extremely well. And I didn't know any of this until, I sat there and listened to him. And I was the next speaker, by the way. So there was something he brought up that I had a little bit of an issue with. It was a small one, but I brought it to his attention. And he agreed with me. Both of us have called the top near the $48 mark. And he's been better than me from the aspect that, he basically stayed short or stayed out of the market for a very, very long time. And now he thinks there's going to be one more bottom. And so a lot of our readers are like, David, is there going to be one more bottom? The answer is, I don't know. I've already stuck my neck out. I said at the bottom in late November, early December of last year, where silver had a print of about 14, 15 was probably it. Spike lows are pretty common in the silver market. There's definitely a spike low, but to be determined. The idea that silver's going to go back to 10 or whatever, pretty hard to say since I've been beaten up personally so much. I've gotten a little more and more and more cautious as time has dwelled on. I remember when I thought silver was going to hold the $26 level, which it did for a very, very long time, and it broke through, but I was luckily good, strong enough, or willing to admit I was wrong before it happened. I put out an alert, which we have for our Basic Plus members, and did a video and explained to everybody that we are going to go down below 26. I can almost guarantee it. Of course we did. And if you look at a chart, that was what I call a psychological barrier. It was about the 1550 level for gold, and the $26 level corresponded to that for silver. And once those levels were breached to the downside, that was kind of the oh no moment for precious metals holders that said, you know what, I don't know if I trust this anymore. David Morgan is somebody that's, putting an X over his face, those type of things. And it's been that way for quite some time. So the psychology of the market really, I think, was at that point. If you want to pick a point for me, that's where I would pick it. So what you asked me earlier, well, what do you do? And the point is, if you don't over leverage, if you bought your metal and you know why you bought it, you just hold it. Even though you bought it at 33 or 31 or, 28 or 24 or 20, if you bought it in the right amount, you just hold it. That's what you do. That would be what I would do. I would certainly not want to sell it. If you sell it and you ask yourself, where are you going to go? Are you going to go in the stock market? Are you going to go in the real estate market? How about in the bond market? Really, there's not many places to go, especially now when if you're supposed to buy low, sell high. The miners and the metals are so much of a buy here, not a sell. And that would be my recommendation there. I think the best thing to do if you're underwater. The problem, of course, as we both know, Ellis, is that people sometimes buy too much or they buy the wrong company. I'll tell you, I'm going to digress a moment here, but having a lot of experience in this market, one of the things I learned the hard way was being in the right sector and in the wrong companies. when I was young, I loaded up on all these juniors because I wanted to, make the big hit. And a lot of these other companies were going up and up and up, and some of these juniors were going sideways to down, and I couldn't understand why. And there's nothing more frustrating than being in the right sector, gold and silver at that time, and watching everything go up, but the ones you pick aren't. That's frustrating. As far as timing goes, it's tough, always tough. I'm much better calling tops than bottoms, as I said before. Nonetheless, the best way is just to acquire. I mean, if you got good cash flow, you should be acquiring the whole time it's low anyway. And that way, you can take advantage of these low prices. One thing I would caution everybody, though, is averaging down. Unless you really know the company really, really well, you don't want to average down. You want to take that same money and put it into a different company. That diversifies you and it mitigates the risk. There was a guy, I forget his name, but he wrote a newsletter and had to do with technology, and he was huge on Global Crossing. And the people that got in with him early made a ton on Global Crossing if they were smart enough and didn't adhere to his advice and sold on the way up or near the top or after it topped and started coming down. But he kept insisting what a great company it was all the way into bankruptcy, and kept telling his people to average down, and it destroyed them. So you got to be real careful about averaging down. Now, averaging down on the metals themselves, that's a slightly different situation because it's a hardcore physical asset out of the ground that has had value for thousands of years. That's a little different story than averaging on a mining company or stock in general.
I think that's the only time that you and I have really ever discussed averaging down. It would be relation to the physical metal. I don't believe you've ever said it might not be a bad idea to average down on a particular stock. You've not done that on this program.
No, I pretty much am against it, not only from the situation I just outlined, there's several like that, and my own experience. I mean, going back to, picking the wrong stocks and being a little headstrong in my youth, just not giving up, being stubborn, saying, well, that's got to be a good company. So-and-so that's writing about this company says it is, kind of thing.
Something interesting has been taking place for a while, probably, I'm going to say 8, 9, 10 months. Speaking of averaging down, or at least heading down, oil has taken a traumatic, for some, I meant to say dramatic decline with regard to prices. And it used to be that gold and silver and oil were sort of lumped into the same basket, and they'd rise and fall at the same time. But I think it's safe to say that there has been a decoupling with regard to energy and the price of gold.
Well, I would argue it's slightly different. I think there's kind of a cycle phase where there's a lead lag kind of thing. Certainly all commodities and the most important commodities go together in a bull market. And I forget the gentleman's name. There was a guy, and I didn't study him for very long. He had a very interesting theory that there was kind of a rotation, sort of like in a stock market, where cyclicals lead the market for a while, then technology stocks take over and lead for a while, and then other times even gold stocks will lead for a while. That kind of an idea that different sectors within the market led for a while, and there was sort of a rotation. You could anticipate what would be the next sector as one was dying off, the next one to come to the top. Well, this guy had the same type of theory in the commodities. Again, I didn't study him for very long, so I would argue that it's more something that they don't always travel together. Sometimes there's a leader or a laggard, but regardless, the point you're making, more importantly, in my view, is that, wow, what the heck's going on with the energy sector? And these are my words, not yours, but the energy sector is by far the most important sector in the commodity world. And with oil prices down, what's the trade-off to benefit versus non-benefit? One of the benefits, of course, for mining companies is 25% for the average company is based on oil. So if you get a reduction of 50% in product, a commodity that you need to use, that uses up 25% of your company's resources, energy, oil, to get metal out of the ground, that's a huge boon. I mean, one of the NYSE companies that we follow and have since the $4 level, that's up quite a bit from there, but it's been much higher than it is today, is dropped its cost from about 20, and this is our analysis, not theirs, because some of these numbers always vary a little bit, but we had it around $22 all-in cost per ounce of silver. Now it's down to like 14.5. And not all of that is attributed to oil, but a great deal of it is. So that's a benefit. On the other side, it's been very negative to the shale oil market, because most of the shale oil situations require oil to be about $80 a barrel, and it's not. So that's causing not only wells to be drilled less, a lot of rigs to be on standby, some workers to be laid off, but the much more important factor is the debt burden that exists in the oil industry. And just to reiterate something I think I said on your show once before, but if I haven't, it's probably the most important part of this interview, and that is that the debt burden in the oil sector is greater than the debt burden was in the 2008 housing market. So wrap your head around that. If we are set up in a situation that's worse than the 2007-2008 financial crisis, and we are, because there's more derivatives, the banks are better liquefied, but the derivatives situation is worse. And rather than the housing sector, this would be the oil sector, which affects as many people or more than the housing sector, because not everyone was out there buying a property on speculation that the price would always go up. Oil affects everybody because it's transportation, it's food, it's everything that happens on the planet almost has oil touching it in one way, shape, or form. So that's something to be cognizant of. It's something that I'm concerned about, and it's something to watch carefully. In fact, when this first started, meaning the oil price started to drop, I said you probably wouldn't see any real world problems in quotation marks until about the May time frame. So we've got about another month, but I think by the next month or so, we'll probably start reading, even in the mainstream press, defaults or debt that can't be paid, or extending the debt payments, or taking less, or so you'll start to see problems come to the fore.
All related to energy. So in other words, there may not even be a bottom that we've hit with regard to oil, even as it creeps back up to $60. And if something happens in that sector, are you saying it could affect the economy much like what happened with the real estate bubble or bust back in 2008?
Yes, I am. There's a lag between what's on paper debt-wise and the real world. In other words, most people don't go bankrupt overnight once they are bankrupt. I mean, let me explain that a little maybe. It just means that you're out of money, but your creditors don't necessarily know it. They're sending you a notice to pay your credit card bill and you ignore it, or you call them and say, I can't make it this month. Say, okay, well, I'll start next month, or when can you, or whatever. But so there's restructuring that goes on, there's delay, there's ignoring it. So it takes a while from the day that you're really bankrupt until everything catches up to you, so to speak. Well, that's on a personal basis, but I use that as an illustration to the corporate world, where you're XYZ shale company and you have all these loans and you've been drilling like crazy and things were wonderful once oil was over $80 a barrel. But now that it's at 60 or whatever it is, and it's under 80, you cannot service your debt. And so this takes time for that to catch up, for the day of reckoning, so to speak. But that day is approaching, and again, I forecast probably May or so. Now, if we get a huge surge in oil prices and they stay at above, let's say 80 as an example, there's not it varies company to company, but 80 is a good rule of thumb, then everything would probably proceed on and there'd be no big problem, so to speak. But as it exists now, and the way I think it is going to exist for the next year or so, it could cause some big disruptions on the debt side of the oil market.
So it's a potential recessionary event that you're describing.
Yes, it could be. Yes, it could be a recessionary. It could be more than that. It could be mitigated perhaps in a manner that I haven't thought of yet. I certainly don't have all the answers. I usually have much more questions than I do answers.
Do you think Vladimir Putin could mitigate it?
Yeah, that's a good question. Yeah, he probably could get enough oil out of the ground. It's not an oil problem. We have plenty of oil. At least that's what the market's telling us right now. It's not that. It's the price of oil that's a problem. So as I said, it's two sides of the same coin. In some places it's a big benefit, in other places not so much. So it's kind of a curse. So just have to look at things objectively from both sides. And I'm probably very difficult for me to do that in the metals, because I'm so biased from the study of monetary history at all. Everything I've looked at for 40 years, it's very hard for me to be objective about honest money versus the paper paradigm Ponzi scheme financial system that exists today. I'm pretty biased on that, but I try to stay objective. It's certainly on the mining stocks we try to stay objective, and on the metals themselves. If you go back to one of the first things I wrote in the public domain, the 10 Rules of Silver Investing, I encouraged everybody to take about a 10% position, or no more than that, 20% at the most. I also encourage everybody to dollar cost average. It's very difficult to time the market, so just decide it's a good investment and buy it over time. So, and those are free. I gave that information out for free. It's in writing. You can, a lot of times I'm misquoted, not often, but sometimes I'm misquoted, especially going back to the heyday. I remember so many shows I'd be at, and someone would come up and say, I read your blah, 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 blah. That's not my article. That was, Ted wrote that. Or, hey, I heard you, da, 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 da. That wasn't me. That was Jason Hommel. You know what I mean? But, people kind of see what they want to see and hear what they want to hear sometimes. And that's okay. You can't control that stuff. It just happens.
Well, I might be skeet shooting here without my glasses on, but will any of this that we've discussed, a potential collapse of the energy market with regard to oil, positively affect the price of silver?
Yes, I still am an adherent studying history that gold and silver, particularly gold, are more of a crisis hedge than an economic hedge. And I know there's lots of people say, well, it goes inverse to the dollar, and that's all you have to think about. There's other people say it's an inflation hedge, which, Professor Roy S. Jastrow really proved it's more of a deflation hedge than an inflation hedge. And he also showed in that book, and what he did on silver, the restless metal, that one, it isn't a constant always that every time gold reacts this way to a deflation, but the majority of the time that it does. And silver was much more erratic, what you'd expect it to be. So you have to kind of use all of the tools available, which means, reading those books a couple of times, how silver and gold have reacted in the more current day, because that's more important, is near-term data than long-term data. It's always that way. That's how these trading software programs are set up. They're set up to bias or weight the near-term trading activity more importantly than the longer-term trading activity. And that's correct because it emphasizes sort of the mood of the market, if I'm making sense here. So what I'm saying is the mood of the market has shown me that gold and silver react more as a crisis hedge than anything else at this point in time. And so what that means is if there's an oil fallout in the debt markets because of over-leverage or borrowing money that can't be paid back, that you would probably see the gold and silver markets rise. You got to remember in the 2008 crisis that something a lot of people have forgotten is, yes, gold and silver went down with the crisis, but at the bottom they were selling at huge premiums. Remember, in the silver market, in the retail side, you had to pay about a 30% premium to get real silver in your hands. And on the gold side, it was I forget, but it was like a 10, 12% premium. Usually it's, 5-6% premium. So that was for physical. And they rose up very quickly. It was a V bottom. It was something that, paper paradigm really is what took them down because there was so much leverage in the futures markets, the ETFs. So the money managers were, basically selling anything they can. And of course, selling paper gold or paper silver is nothing. It's just a click of a mouse for them. But they rebounded quite well. And from the 2008 bottom, did extremely well up into the 2011 top. So I think if there was another 2008, I put that in quotation marks, if there was something similar to that, I think you might get a quick move down in the metals like last time. But I'm not even sure that would happen. I think that it's possible that they could just actually stay steady and start up instantly. I think the physical market's much tighter than the price would indicate. And I think there's a lot more people more aware of where to go when this type of thing happens. So again, crisis hedge, don't know where to go. I'm going to park in the metals.
Well, what's interesting is from 2009 through 2011, there was quite a boom in the mining sector with regard to metals, the physical metals, and the stocks. And what's different about today is we weeded out a lot of these companies. We're near a bottom. If we haven't already approached it, we're probably better positioned now as potential investors with regard to mining stocks and physical metals than we were in 2008, 2009, correct?
I think so.
David, tell us about the Morgan Report for those who are just listening to us for the very first time, and I can't believe that's true.
First thing to do if you're interested in our work is to get to the website silver-investor.com or themorganreport.com. Either one takes you to the website. And you can get on our free weekly weekend edition, which is an e-letter that's free for everybody. And then if you want to subscribe to the members part of the website, there's the ability to do so. And you just hit the subscribe button. The Basic Plus service is the one that's the most popular by far. It does all the videos for the mining trips that we take and any of the lectures that I give that I'm allowed to film. And of course the update at the Silver Summit, where we film almost every silver company that attends the Silver Summit. There's a lot of information. In fact, we also have a software package that comes with that level of service that actually puts a widget up on your computer. So when we do a market alert or an update, it actually sends a signal to your computer, a little pop-up window, and says, hey, I've got an alert for you, take a look.
Well, David, it's been a great pleasure speaking with you today on the program. Thanks so much for joining me.
It's my pleasure. Thank you, Ellis.
I've been speaking with David Morgan, the Silver Guru. Find him at themorganreport.com and listen to this segment again on the homepage of the ellismartinreport.com or download the entire Ellis Martin Report